All right, so this market is starting to become somewhat unpredictable, but I think if you look in the larger picture, I think it is predictable. So this week we had a very interesting week. We had a massive down day on Thursday, and then we didn't close up on Friday, but we did make up a lot of the downturn we had on Thursday. And if we look at the S&P here, there's some interesting trends that emerge here, and that number one, we haven't gone below, I mean technically on Thursday we did, but we haven't closed below the 50-day moving average since it looks like early January. So it's been basically 3 months since we've closed, at least on weeklies, below that 20-day moving average. So that begs the question, when will we break that? My prediction is I think that's going to happen very soon. I think over the next month or two, maybe 3 months, we're going to see a 5 to 10% pullback. And after that, it all depends what happens with rates, what happens with the economy. If the if the Fed panics and lowers rates, that probably is good news. But again, nobody knows. The thing when it comes to this is it is impossible to predict. But I think based on, again, I follow the market very close. I mean, aside from people who aren't professionals, probably pretty much as close as you can. Based on my guess, I think that we'll see a 5 to 10% pullback over the next couple months, maybe 3 months. It could happen even literally next week. For the reason being, I think we're a little overextended. And the bullishness, I think, is dropping off a little bit. And I think people are going to start to say, hey, what's going to happen with rates? Because if things stay higher for longer and the economy gets weaker, that probably isn't good news for the market. But let's say the Fed does start to say, hey, they're still saying they're going to cut 3 times this year, but I don't know if that's going to happen. I mean, for the reason being, one of the reasons, look at the 10-year here. The 10-year Treasury is as high as it's been this year to date. It's the highest it's been since November. So that's something that kind of questions that line of thinking. So I think that's something that people that I've been saying for the last month or two, and I think something that the people are really going to have to start considering here is we very well could see no rate cuts this year. Like, that is a real possibility. Now, again, to start the year, they were pricing in something like 6, and now we're down to 3, and again, we could see literally nothing. That is a distinct possibility. Number one, because inflation still hasn't gone below 3% or maybe like 2.8 or whatever the number is. So that's concerning. And not only that, at least based on most numbers, the economy is not as weak as what you would expect for the Fed to be cutting rates. So there's a lot of concerning things there. There's a lot of variables. Nobody knows really what's going to happen. But again, my prediction is very clear. I think more than likely they still do cut, but I think that the odds are getting less and less as the days go by. I think that the only way that, honestly, I don't expect 3 cuts this year. If I was betting, I'd probably bet 1 or 2, right? Right where we stand right here and now. The only way we get more than that, or more than, let's say, 75 basis points, is if we get a major crash. And that's distinctly possible. That is distinctly possible. But nothing really points to that right now. I mean, the yield curve's inverted. That's true. But the yield curve's been inverted for a year and a half, 2 years. I don't even know what it is off the top of my head. And again, nothing looks overly broken where we stand right now. So I think that the market is due for a pullback, but I don't think it's going to be anything crazy. And I mean, another thing that not a lot of people are talking about is with higher rates, that means that anybody who holds bonds, they're getting that 5% or whatever the number is. That's a lot more than it's been over the last decade and a half. And that is de facto government stimulus. Because if you're getting 1% on bonds before, now you're getting 5%. That's a lot more money that people have to spend now. So I think that's something that is propping up the economy, at least to some degree. And I think we'll continue to do it, at least for the foreseeable future. So that's another thing that I think probably is not talked about enough. As far as other news goes, Bitcoin is another very interesting one here. Bitcoin, again, is trading in a range here. And I mean, if you look at this range, it's basically between, I mean, it hit, I guess it topped out in mid-March. Looks like it was like March 13th, 14th. It topped out at just under 100,000 Canadian. I think that's around 73 US. And again, ever since then, we've been as low as about 85 and as high as like 94, 95. So again, that's about, I think, 60 to 70,000 US. And again, I think that Bitcoin is, I'm still extremely bullish. Like, I don't know any reason why you wouldn't be extremely bullish. And I mean, if you want me to name the reasons, number one, I mean, there's never been a halving cycle where you were above the all-time high prior to the halving cycle. Now, where we stand right now, I don't think that, at least in U.S. dollars, they're literally within 5%. So I mean, for all intents and purposes, the Bitcoin can move 5% in a day or a half a day. So that's something that's very bullish. You have the miners talking about how we're getting calls from the ETFs and stuff saying, hey, we can't find enough on exchanges to buy. We have the halving, we have the ETFs. We have more and more institutional investors that are opening up to the ability to do this, the ability to invest. So I don't think that people, I'm as bullish as I've ever been. I mean, frankly, and I don't see why you wouldn't be. Like, why would you not be? I don't think people are comprehending the fact that, I mean, number one, like literally 90%, again, I don't know the exact number, but it's right around there, of the Bitcoin that ever will be mined has already been mined. And on top of that, we are seeing record demand. And not only that, to cap it all off, the supply coming online is literally going to be cut in half in about a couple weeks. Like, I don't think people recognize the significance of this. So again, Bitcoin, I don't see why you wouldn't be bullish where we're at right now. Oil, again, is also reaching year-to-date highs. How long has it been since oil's been this high? October. So again, it's been 7 or 8 months, 6 or 7 months since oil's been this high. That's very interesting to see. Again, I think this is largely due to, I mean, I believe OPEC cut production, and you have the tension in the Middle East. So good news if you're an oil investor here. And again, I think this is probably going to be in the near future. Again, unless we see a prolonged recession in the States or in China, oil probably does stay higher rather than lower. And again, it was the longest time it couldn't even get above, probably for four months roughly. It would not go above $80, and we're at 86, 87. So very interesting to see how high oil will get. Will it go back above 100? Looks like in September it was in the 90s. So that's very interesting to see what that'll do. As far as the mock portfolio goes, again, the strategy here, honestly, I've changed it a little bit, but it's still pretty much the same. Again, the vast majority of the portfolio is still in bonds. Again, Bill, that is the short-term T-bill ETF, again, getting about 5%. SPHY, that's the high-yield corporate ETF, again, getting about 7.5% yield. USHY, again, another high-yield fund, that's about 6.5%, I think, roughly. Again, one thing you'll notice is that both of these funds are down a little bit, and again, that's because that 10-year is up. So again, that's a very important metric to follow. What's going to happen with those bond yields going forward? Again, the strategy here is quite simple, like I've already outlined before, and I think this is the best way to be managing money right now. The market is clearly expensive. Now, to be fair, that doesn't mean that there isn't any stocks that are at fair value, because I think that probably, I don't know, 20% of the stocks I like, maybe even 25, maybe 30, I don't probably not 30, but 25% of stocks that I like, you can be buying where they're at right now. I mean, EQ Bank I think was a good buy. I mean, it's up to, just below 89, but it was in the low 80s for the last couple 3 weeks. Alimentation Couche-Tard I think is you can be picking it up where it's at right now. Paycom Software I like below like 220. QLYS, I'd probably like to get a tiny bit cheaper, but I don't think it's crazy expensive here. Dollarama, again, I wish I could have got more because they released very good earnings, and again, they jumped up about 10 or 15% in a week. So again, I wish I could have got more of them, but again, what can you do there? Microchip Technology, I like them where they're at. I don't think I'd be adding more, though, at least right now. CEIX, again, I'm not jumping in right now. ARLP, the uranium ETF is back above 30. I wish I would have picked up a little bit more of that when it was at like 28. But again, uranium is something, again, I think as far as a speculative upside play, I really like it going forward. Watts Water Technologies, again, below, I think around 180, the 180s, even low 190s, I'd pick it up. BAM, again, I like that as well. NAPCO Security, that's more of a speculative play. Brookfield, again, these are all, again, my strategy is simply selling cash or puts to try and enter these positions. So again, selling puts mean what the play basically is I want to own this stock, but I want to own it at a lower price. So what I'm going to do is I'm going to sell puts at a lower price. I'll collect the premium. If the stock stays above where the strike price is, you don't do anything. You simply keep your premium. If it goes there, okay, you get it at the price that you want, or at the very least a lower price. So I think that is the best way to be doing things right now. With a lot of these companies that are overvalued, that you think that you want them, but you only want them at a price that's lower than where they're at, you simply sell puts. The problem with this, the caveat, is you can't do it in a tax sheltered account. So that's the one caveat to it. But again, this is a basically a mock account, so it doesn't really matter. So again, there's a lot of companies that I would love to own here. Again, my stance on this has been quite clear for a long time. I do want to own probably 50, 60 positions at someday in this portfolio. The reason for that is I think that there's a lot of good companies out there, and I think that owning that many, you can be very well diversified. I think once you go above that, once you go like 80, 100, I think it just becomes too hard to keep track of. I mean, a lot of people would argue that for 50 or 60, but I think that if you're willing to put a little bit of time in, you can do it. And I mean, on top of that, if you go above that, you're getting to the point to where you're kind of just getting a lot of the same. Like what's the point of buying MasterCard and Visa? Like, why not just buy whichever one is better? What's the point of buying 5 oil companies? Why not just buy the 1 or 2 that's the best? So that's my thoughts on that. So anyway, that's what I wanted to bring up today. If you liked the video, please like, subscribe, comment, all that good stuff, and stay tuned for more.